Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you've joined us for the Precious Metals and Critical Minerals Conference. The next presentation of the day is from Anfield Energy. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings by clicking Book a Meeting. At this point, I am very pleased to welcome Corey Diaz, Chief Executive Officer, Co-founder, and Director of Anfield Energy, which trades on Nasdaq and TSXV under the symbol AEC. Welcome, Corey.
Thank you, Lily. And thank you, everyone, for joining this call. Anfield is a company which is aiming to be in uranium and vanadium production by 2027 using a hub and spoke production strategy. I'll walk you through our plans to get to that point by 2027. Safe harbor, read at your leisure. Our capital markets profile, as Lee mentioned, we trade both on the TSX Venture and on Nasdaq. Our largest shareholder is Uranium Energy Corporation, holds about 29% of our shares. Uranium Energy Corporation is about a $7 or $8 billion company. We do have research coverage out of Red Cloud in Toronto with a target price of $17 Canadian. You can see the picture to the bottom right is actually a picture of the mill. The mill is one of only 3 licensed, permitted, and constructed conventional mills in the United States. The reasons to invest in the company: we've got a large portfolio of conventional uranium and vanadium assets in the United States, underpinned by the mill that I just mentioned, the Shooting Canyon Mill. One of only 3 licensed, permitted, and constructed conventional uranium mills in the United States, so a great deal of scarcity value there. Our assets are all located in a strategically historical production area with a lot of production over about 50 or 60 years. So we're looking at Utah, Colorado, New Mexico, Arizona. Our hub and spoke production strategy has been put to paper in the form of a PEA that was put out in 2023 using Shooting Canyon Mill as the hub and our 2 most advanced mines, the Velvet Wood Mine in Utah and the Slick Rock Mine in Colorado, and that returned an NPV of $238 million. Our plan right now is to advance the mill from its current standby status to operational through a license amendment. We're working on the license amendment with the state of Utah at the moment. We expect to see approval for that license amendment in 2026, after which we'll start the refurbishment of the mill. And then finally, we have been working on, and we have been granted access to the Nasdaq market, which was a big milestone for us. So we've got great exposure to the US market and to US investors, especially given the fact that our assets are all in the US. And the picture to the left, you can see a shot of the mill itself. So company catalyst for this year, as I mentioned, we're working on advancing the mill to production. First of all, the license is currently on standby. As we move to operational, we're also looking to increase the throughput at the mill from 750 tons per day to 1,000 tons per day. We're also looking to increase output at the mill from 1 million pounds per year to 3 million pounds per year. In terms of the assets that we have within the portfolio and the potential economics derived from those assets, we are putting out an updated PEA in 2026, which will incorporate not only Velvet Wood and Slick Rock, but some of the other mines that are included within the portfolio. Given that we did use a $70 uranium price in 2023, and given that the uranium price is more likely to reach triple digits this year, we'll look to increase the price used within the PEA in order to derive improved economics. We are doing some pre-construction work at the mill, pulling out some pieces of the mill that won't be used going forward, that won't be subject to refurbishment. So for example, we're pulling out the leach tanks that have been there for 50 years, which are redwood. We'll be replacing those with steel tanks. We'll be replacing the electrical and some of the power generators within the mill. And so under our current license, we're able to do those things, but it puts us in a much better position once we do receive the amended license to advance quickly to refurbishment and ultimately production in 2027. And then on the mine side, we are currently under construction at the Velvet Wood Mine. We announced the groundbreaking back in November 2025, We expect to see that mine ready for production by mid-2026. We are advancing some of the DOE leases. We hold 21 DOE leases in Colorado. Of the 29 that are there, we are looking at the most prospective of those ones. We're putting plans of operations in place, submitting it to the state of Colorado and to the federal government in order to get approval to get the mine permits so we can advance those mines. For example, Slick Rock, another mine within Colorado, we did submit a plan of operations for that property. We expect to get that approved in 2026. So by the end of 2026, we expect to have 2 to 3 mines available for production, and we expect to have the mill ready by mid-2027 in order to accept the feed from those mines. And then finally, just in terms of the portfolio size, we have 25 mines in Utah, Colorado, New Mexico, and Arizona. And our plan is to have a long-term production pipeline of 20 to 25 years. So once we even start production, we expect to continue to add more assets to the portfolio in order to make sure that it's an ongoing concern and not a finite amount of feed, after which the mill would shut down. The macro overview of the uranium sector, it's a very global business. There's a lot of geopolitical risk associated with the sector, depending on where you're mining uranium. In Russia, conversion and enrichment, so other parts of the nuclear value chain, there's a significant concentration of conversion and enrichment of uranium in those areas. Kazakhstan, the largest producer of uranium in the world, has pivoted towards China as China's building out a number of reactors. So a lot of the pounds that will come from Kazakhstan to the west are now heading east to China. Niger, Orano, one of the larger French producers of uranium in the world, has lost its ability to mine in Niger due to a coup. That means that there are fewer pounds coming into the market from that region. And then finally in the US, with the largest installed nuclear reactor base worldwide, it produces about 2% of what it requires. So it's dependent on a fair number of outsized producers of uranium in order to meet demand within the US. But opportunities continue to take shape in the sector. There's a massive build out of reactors worldwide, which means that there'll be a greater need for pounds which can be produced. Japan is restarting its reactors. As you may recall, 54 reactors were shut down as a result of Fukushima. 33 of those reactors can come back online, and they're probably about 2/3 of the way of getting those reactors up and running. So pounds that were being held in Japan, which could potentially have been sold into the general market, are now being held in Japan, and Japan is now a net buyer of uranium. The US is looking to quadruple its energy production, which would include nuclear, over the next 20 years, which means that there'll be significant increase in demand for uranium going forward. The AI phenomenon related to the sector, we've got Microsoft and Constellation signing contracts in order to reopen shuttered reactors, which once again would require more pounds. Multiple executive orders have been put in place by the Trump administration to advance domestic production of uranium and other energy sources. And then the Section 232 investigation, which was initiated last year related to critical minerals, has come back, with another step towards making sure and acknowledging the shortfall of critical minerals in the U.S. With a plan to highlight and help advance the assets that are within the U.S. But supply, once again, is the big challenge in the sector. As I mentioned, Orano has had challenges in Niger. Cameco's production was down last year and the year before that. Physical uranium funds continue to buy pounds out of the market, which once again tightens supply. And then Kazatomprom not only selling to places in the east, but also the fact that production has been down as a result of the lack of acid related to production has made it a bit more challenging. So fewer pounds in the market and greater demand on the nuclear reactor side means that higher prices are required in order to bring more mines on. So we think we're well positioned, especially in the US, given that the US consumes 50 million pounds per year and produces about 1 million pounds. We believe that any pounds that we can produce in the U.S. can be easily absorbed into that market. So we think we're well positioned from that perspective. Here's a picture of our production plan. If you can see the picture to the top right, the Shooting Canyon Mill is depicted by a gray dot. Our two most advanced mines, the Velvet Wood and Slick Rock, are depicted by the darker blue dots. And those are the properties that comprised our initial PEA back in 2023. We plan to add more mines to the updated PEA, which includes some from the West Slope properties. West Slope comprises 9 of the 21 DOE leases that I mentioned. But we also have other mines, both the Frankham right next to the mill, Finley Tank in Arizona, and then not captured on this map, but one of our larger assets, the Juan Tafoya mine in New Mexico, is also something that can be potentially restarted and shipped to the mill. So the Shooting Canyon Mill itself, you can see the pictures to the right, shows you some of the inner workings. You can see it's an existing facility. Some parts are, fit for purpose, and some are not. Our plan is to continue to move this asset forward, start some early decommissioning work, and then ultimately, once we receive the license this year, we will start the refurbishment process. Sorry, and one other point to be made here. So not only are we restarting the uranium circuit, but we're also adding a vanadium circuit, because within our portfolio, we have 100 million pounds of vanadium, which could be certainly profitable and certainly could be used for things like vanadium flow redox batteries in order to provide large industrial type power. So the pipeline of projects, as I mentioned, so this is these numbers come from the PEA that was put out in 2023, the pre-tax number of $238 million, the post-tax number of $197 million. That gives you a sense as to the type of production we're expecting to do per year and the recovery rates related to starting and restarting production. The Velvet Wood, as I mentioned, our most advanced mine, has past production of 4 million pounds of uranium and 5 million pounds of vanadium. There's an existing resource in place. Slick Rock, once again, this asset, about 8 million pounds of uranium and 47 million pounds of vanadium. So a significant portion of our vanadium caught in this asset alone. And then the West Slope property, as I mentioned, consists of 9 historic mines, past producing mines, the most advanced and the most recently mined assets within the portfolio. For the 9 mines, we've updated the resource, and those returned a resource estimate of about 5.4 million pounds of uranium and about 27 million pounds of vanadium. So significant resource at all these assets, and certainly allows us to create a pipeline that could be relatively long running. And then as we start that process, we look to acquire more assets to add to the back end. So this is our secondary pipeline acquisition that we made back in 2023, the New Mexico asset I mentioned, Marquez Montefoya. This is our largest single uranium mine, about 18 million pounds of resource. There was a PEA for this asset done by the previous owner. There was an NPV of about $21 million at a $60 uranium price. The sensitivity to the uranium price is quite significant, because at $70, the PEA, the NPV turns to about $73 million. So if we're looking at $100 uranium, that could be a significant upside in terms of the value of this asset. It gives us a toehold into New Mexico, if that's an angle we choose to pursue. It certainly allows us to be flexible with this asset if we're looking to trade or swap or JV. It gives us a bit more flexibility within the portfolio, and that's what we tend to do. We tend to look at ways to advance our asset base, our core asset base, through acquisitions, divestitures, joint ventures, et cetera. So this is something that we could potentially put in to production once we finish with Utah and Colorado, but it also gives us the chance to advance this asset, separately or through a joint venture. So our steps to production captured here. Near term, we're focused on sharing Velvet Wood, Slick Rock, and some of the other DOE leases, as I mentioned, through West Slope. We do have a PA out, and we're planning to update that PA to incorporate other assets within the portfolio. Midterm, we're looking at the West Slope assets in Colorado, which are the 9 DOE leases, plus the other 12 DOE leases we acquired back in 2024. So we have 21 DOE leases from which we can determine the most prospective and advance those. And then longer term, as I mentioned, assets like the Juan Tafoya mine, the Frank M mine, and the Artillery Peak mine in Arizona. These are assets that we could potentially restart once we've completed our work in Colorado and Utah. But they also serve as opportunities for us to joint venture or swap in order to get assets which are closer to the facility or fit better into our portfolio. So peer comparison, I think this is an important slide. These are the companies which are either near production or in production. So that would be Anfield to the far left, followed by Energy Fuels, UEC, Uranium Energy Corporation, Encore, and Ur-Energy. You see our market cap is dwarfed by all of these players. The smallest of those parties on the slide are almost 5 times our size, so the Encore. We think that the valuation gap is unjustified at this point, and we think that within the next 12 months, we should be getting closer to at least the smallest of those companies, given our production profile and the opportunity within the sector. And you can see that it's fairly limited to a handful of companies that have the ability to process uranium, and that's the big differentiator for these companies, vis-a-vis our other peers, whether it's in Canada or the US. But I think there's significant upside in terms of the valuation just looking at this chart, given that we are on our way to production within the next 12 to 18 months. Management directors, that we already talked a little bit about me, but we co-founded this business back in 2013. I co-founded it with Josh Bleak. Josh Bleak is a 4th-generation miner out of Arizona. His family's worked in uranium and in uranium mines for a number of generations, and he's our man on the ground in the U.S. I spent a lot of my time on the financial side and looking at ways for us to build better economics in order to advance the assets, whether it's through M&A or other opportunities. Doug Beam, our CEO, has been in the sector for about 50 years, has built both mines and mills, had known a lot of these assets before we even acquired them. And so he brings a great deal of experience as we look to advance the mill to production. Ken Mashinsky, he's the CEO of Rare Earth Elements, but he spent 33 years with General Atomics, which is the owner of Cotter Corporation, from which we bought a number of assets years ago. But he also ran one of the other subsidiaries of General Atomics called Quasar Resources out of Australia, which was producing about 5 million pounds of uranium per year. So he's very familiar with a number of different facets of the nuclear cycle. Don Falconer, 35 years in uranium. Ross McElroy was CEO of Fission Uranium, sold to Paladin, I believe it was $1 billion deal. Jeff Duncan, our most recent joiner to the board. He's a former House representative for South Carolina, has sat in the Natural Resources Committee and the Energy Committee. And so he's our person on the ground in Washington and has facilitated a number of meetings with significant people within the administration. And then we've had, Steve Lunsford has been 40 years as a geologist working for Chemical Resource. So we have a lot of experience on our board when it comes to uranium and production and access to potential government funding. So a little bit more on Velvet Wood, just give you a sense that we acquired this back in 2015. There's a lot of infrastructure in place already. This is why it's the most advanced mine that we have, and our plan is to get this up and running by mid-year this year. We think it's a significant opportunity for us to build out a resource and that is well known and has shown past production. Slick Rock, you can see that Slick Rock, the green shape up on the top right, is surrounded by a number of blue shapes, one of which we actually hold as one of our DOE leases. You can see the proximity to Slick Rock, and our properties. And in general, we can look at the opportunity to amalgamate assets in order to create a greater mine plan as we move forward. So there's a lot of flexibility within the portfolio. And then West Slope, as I mentioned, these are 9 past producing mines we acquired from Cotter Corporation. There's a picture of JD6 to the top right. You can see there's still rail line in existence. The access, the adit is still open. There's equipment within there. There's ore. So these are fairly, easily restarted mines for a very low capex. So that's why we're pursuing, production of from these assets alongside the Velvetwood mine. And that's the story of Anfield. So happy to take questions if you have any now. Okay, so I'm reading through the questions here. I'll start with number 1. Let's see here. So the first question I see, what are your milestones for 2026, and do you have the capital in place to support? So our plan is the milestones include the receipt of an amended license, after which we'll do the refurbishment of the mill. So, we've got the license this year. We expect to start refurbishment of the mill this year. We expect to have the Velvetwood mill mine up and running or ready for production in 2026. We expect to have at least 1 or 2 other mines ready for production in 2026. In terms of the capital, so we don't have the capital today. We haven't raised the funds today. That said, we do have equity interest from existing investors and other investors. We also have the opportunity to secure debt through debt lenders. And then finally, there is an opportunity for us to get funding from the federal government. As I mentioned, Jeff Duncan, who joined our board late last year, has the ear of a number of parties within Washington, and we've had a number of good meetings, which could potentially lead to funding. So we have a few different avenues, using one or all in some kind of mix to fund what we're required to fund for this year. And the catalyst, I guess this is similar to the first question I mentioned. The catalysts are those that I just mentioned. On to the next question. How are you positioning Anfield to benefit from U.S. policy moves supporting domestic uranium supply, and incentives are you actively pursuing? As I mentioned, we are one of a handful of companies that can actually start production of uranium in the near term. Having a processing facility gives us a massive advantage vis-a-vis other companies which simply have uranium mines available. So the ability for us to start production is attractive to companies or organizations or departments like the DOE, DOI, DOD, and certainly there's funding available from those entities to facilitate production. And so, we've had a number of good meetings, looking at ways for us to secure funding in that regard. Another question, how does Uranium Energy Corp's large ownership stake influence your capital allocation and negotiating with utilities and other counterparties? Well, it doesn't hurt to have a significant investor have an interest in the company. Certainly, as we raise money, UEC has participated alongside our other investors to hold its pro rata share and sometimes improve on its pro rata position. But certainly, it allows us to enter negotiations with utilities and others with a greater sense of credibility. It also allows those utilities to feel comfortable that we will be a going concern as we move forward, because I think that's very important when it comes to smaller companies. The ability to actually execute on their plans sometimes could go awry, but I think we're well positioned. We've been building this company for a number of years, and certainly UEC has seen the appeal of what we're doing, and one of the reasons why it's gotten involved is because of that appeal. So it certainly does help us as we move forward, looking to negotiate contracts. And those are all the questions I have. If there are any other questions, let me know. Otherwise, feel free to contact the company at contact@anfieldenergy.com. You can certainly reach me at cdiaz@anfieldenergy.com. If you have any other questions, let me know. Thank you for your time.